Hello all, and welcome to our event today, Staring Down the Barrel of ESG Activism. We're delighted to have you join us. We've got an illustrious panel, and indeed, I think we will find the conversation really quite interesting today. And we're going to indeed ask a few questions of you, our audience, as well. I think we're still probably having people gathering, but we've certainly got a quorum which are on, so we will get underway. So without further ado, let me introduce my fellow panelists here. So very quickly, I should probably mention myself as well. Leon Saunders-Calvert. I run the research and portfolio management business at the London Stock Exchange Group. Andrew, let me hand over to you to say a couple of words of introduction.
Thanks, Leon. So yeah, I'm Andrew Archer, and I'm at Investor Update, and I head up the ESG advisory business here.
Amanda.
Amanda Spinner. I'm a managing director at Gastalter & Co., a strategic communications firm based in New York and Chicago, with a focus on reputation management and media relations.
Thanks, Amanda. And Kevin?
Yeah, hi, I'm Kevin Smith. I lead the ESG advisory practice within our activism and shareholder advisory group here at Goldman Sachs.
That's great, Kevin. Thank you. So, look, you can see we've got quite a capable panel here, so we're expecting some real insights today. Let me move on to just some very brief housekeeping. You can submit questions to us through the Q&A box, which is available to you at the bottom of the screen. So please do so. You can do that any time during the course of the event. I will look to identify questions as they come in, and if they're particularly pertinent and in the moment, as we happen to be on a particular topic, I'll see if I can wedge them in to ask the panel as we go. And otherwise, I'll make sure that we leave some time at the end for Q&A, so we can make sure that we cover anything that comes through the Q&A over the course of the session. But do log your questions as we go, and we look forward to hearing from you. And with that, to make sure that you're there and paying attention to us and you're with us, we're going to start with asking you a question, a very basic question, which essentially just gives us a sense of who we've got on the line. So as you can see, hopefully on screen, we've got a question for you. Are you an investor? Are you a company employee working at a corporate? Or are you an advisor, or indeed something else? So we'll give you a relatively short time to answer that, assuming it's a relatively easy question to be able to answer. We'll give you another 10 seconds or so to fill that out, and we'll get a sense about then, proportionally who have we got on. As you are responding to that and remembering who you are and what you do, I'll also mention to you that we'll have a few slightly more interesting questions, which we'll ask you over the course of the session as well, and we'll come back to those. So getting used to just sort of playing with this system might be useful for you as we come to questions for the audience in a little while. Sam, my glamorous assistant, will help me now look at the answers that we have from you. Sam, do you want to move us on? Great. Okay, so most representation from the sort of corporate community, effectively a company employee, with investors and advisors in equal second, and a few others. Of course, we don't know what that is, but we're delighted to have you all here, irrespective. So, without further ado, let's get into the panel discussion. Andrew, I'm going to, on screen, by the way, are sort of some of the topics that we'll cover and we'll move in and out of during the course of the next 40 minutes or so. But Andrew, let me start with you. As the author of the recently published report, Staring Down the Barrel of ESG Activism, what have you seen, what have you identified, what's come out of the research that you've done on the trends and drivers that have informing ESG activism activity over the course of the last few years?
Yeah, sure. Thanks. So yeah, there's a number of drivers that have brought us to where we are. I'd say I could summarize them as being between growth, alignment, opportunity, and a value dynamic, which I'll explain. But certainly, growth is profound. We've seen such growth in interest and in the agenda and in capital flows. So we've seen, by some definitions, assets under management get close to or through $40 billion, $1 trillion now. So that's a third of the global total. So that's driving a number of agendas. Obviously, that creates a huge influence on the market. Not all of them positive. But that we haven't seen that kind of growth that rapid probably since dot-com bubble. But alignment within that growth is really surprising. So this is where a number of players who have been taken different views over time are suddenly finding that they agree on key issues of the moment. And obviously some of these relate to alignment, but all of the environment, but all of ESG is affected by this. And it's very powerful when you get significant institutions agreeing on a direction of travel strategically or investment terms, and that alignment is driving a lot of the outcomes we're seeing, and a lot of the campaigns as well. And those campaigns are the opportunities. So in a fast-changing industry, what the work found was some companies obviously are leading, others are lagging, but that increased vigilance and scrutiny on industry is showing up where there may be opportunities for change. Change often coming externally, and that's where the activist interest has come in. And that's because, as ever, is there a value consequence to this? And it's that we find those that are leading will have better access to capital, perhaps a lower cost of capital, and certainly valuation is improved. And if that's being applied differently through different sectors, that's brought that interest in, and it's mobilized a lot of capital and interest. So those are the key things that we saw, and it's certainly driving the activity, and it's accelerating, actually, I would say, at the moment.
Thanks, Andrew. And I'll look to tease out some of the pieces of that with some sort of questions going forward. But Amanda, let me come to you initially. Is what Andrew's just taken us through in terms of the trends and drivers, is that consistent with what you see on the ground day to day, particularly in light, of course, of the pandemic over the last 18 months and how that affected positively or negatively the activism trends?
Sure, and thank you, Leon and Andrew. I think that I agree with everything that Andrew just said. I think we've certainly seen an uptick, particularly over the last 18 to 24 months in terms of investors' focus on ESG issues at companies, and particularly finding an opportunity to take an activist position, whether that's through a more engagement-like tactic or a proxy campaign. Obviously, we saw the engine number one success at Exxon this year. I think that what we're seeing is investors really grab onto these issues and treat them as economic arguments, not just ideological ones. I think for quite some time, these issues have been in the background, so to speak, more so. And we've seen, shareholder proposals, just using Exxon as an example, brought forth for years, but really the intrinsic link between climate risk and business risk was not brought to the forefront. And I think we're seeing that argument develop much more so now, as Andrew said. And I think that, frankly, with climate change issues coming, there's been a lot of focus and the pandemic and supply chain issues as a result of that on the E. I think we're going to continue to see an increase on the E, but I think we're also going to see an increase in people focusing and investors specifically focusing on the S. I think the G has always been in the background. Governance issues have precipitated at companies for years. They're sort of the crux of proxy campaigns and the board, but I think we're going to see an increase in people thinking about social issues as well, and human capital and those types of drivers going forward in terms of ESG activism. The one thing I will say, which, it remains to be seen, I think that, again, with engine number one and the Exxon campaign, we now saw that, shareholders can't be ignored. And while there might be an uptick in, activism or engagement going forward, I think that there's going to be, and there should be, frankly, a lot more attention from companies paid to these shareholders of any size. So while we might see an uptick in people engaging, hopefully, not hopefully, but we may see a little bit of a downturn in proxy campaigns themselves if the engagement goes as it should behind closed doors more privately.
Very good, thank you, Amanda. Kevin, let me turn to you. ESG activism as a force for good. I think activism generally has sort of had a checkered past in terms of its own brand, if you like. But is that changing as a result of focus on ESG? And I guess a follow-up question, but I'll ask at the same time to see if I can, weave that in as well. how strong is the link, which I think actually Amanda just sort of hinted at, between environmental or ESG status of a company and its bottom line?
Yeah, sure. So look, ESG activism, and I think more broadly, even ESG investing as a practice, I do think can be a force for good. But as Amanda kind of alluded to this in her remarks, it does need to be grounded in an economic thesis. I mean, I think that's the big differential between how you think about the private sector and the public sector and philanthropy and so forth. Is in a private sector investing context, the linkage really needs to be pretty clear. And most of the investors that I think are doing this well really look at the world of ESG or sustainable investing as really identifying three key areas of focus. Looking at downside potential risk company may face, and that could be everything from climate risk, transition, or physical risk in that context, embedded carbon as an example, or as Amanda was mentioning, human capital costs or supply chain disruption. So where are there companies that or maybe have higher levels of risk in them that there could be a value creation opportunity by better managing that risk? The second area is what I call kind of operating efficiencies or potential for margin improvements, better operating your facilities, thinking about energy efficiency within your facilities or water efficiencies, other ways where you can improve your margins essentially by factoring sustainability attributes into that performance. And then the third area is, particularly in sectors where there is transformation going on, are you poised to be, are you in a position to essentially capture upside opportunity in the changing dynamics within your industry? All three of those requires you to have, strong governance, a strong management plan, strong strategy in place. And so I do think that those are the types of things where you see both a positive impact in the real world, but also potential to really create value from an investing perspective. To your second question, we are starting to see greater linkages in valuation and performance for companies that do this well. So we have an equity research team here at Goldman called GS Sustain. They've long covered kind of thematics around sustainability and long-term, kind of investing trends. They've done some work that looks at companies that tend to be more overweight in overweight from an ESG fund perspective, and we've seen pretty discernible differences in valuation premiums between those. They've also looked at companies that tend to perform well, not just from a disclosure perspective, but from an actual underlying performance perspective on ESG metrics, have a key difference between the top quintile and the bottom quintile. And so I think as more data becomes standardized, I think as more research is done in this regard, you are going to see more of that kind of hard evidence that showcases that companies that operate well tend to be tend to get an outsized flow of capital, which has a play through to their valuation premium. So I think ESG activism, to get back to the original question, I do think it can be a force for good. I do think it has to be kind of anchored very much though in the value creation side, which is the traditional form of activism. So we're seeing those worlds kind of merge together more recently.
Thanks, Kevin. And Andrew, I just wonder if you have any further comments on that. In the report that you created, you talked about activism in the past as being perhaps looked at as economic opportunism. And so I wonder whether or not you have a view on whether or not this sort of renewed focus on ESG activism within, with all the context that Kevin just took us through, is enabling it to go through a sort of a positive rebranding process.
Yeah, sure. I mean, I think that's right. Whatever the history of this, an idea of something being good is very subjective. But like in terms of activism in its own right, that has always served that purpose of sort of clarifying, cutting through and capturing benefits which may be good for investors and shareholders. What's important is when that positive element from one part of the investment world connects with values that are from other stakeholders, and where those investors have a broader view of what's important. That's institutional investors, but it's also the private, the individual or indeed sovereign wealth agendas that may be behind that. And so their idea of what is important, valuable in a sort of in a world context, when that comes together, that means a broader opportunity to be good. But also it's a speed, right? It's a good thing to act quickly. We can see there's an urgency in many of these challenges that that we're facing, and to do the right thing over a longer period of time is not going to help anyone. So the good thing in this is that it can be very rapid, and the campaigns that we've seen have accelerated. As Amanda said, some things have been around in the past for a while. The efforts have been made repeatedly through the sort of AGM process and engagement by key investors, and progress has been slow. But action that is rapid is good, and I think that's what we're seeing. That's certainly one of the things we wanted to focus on. And then you took that into what that meant for valuation, and we also see some of the work we do is around tracking capital flows within shareholder registers and being able to see how specialist ESG mandated capital is flowing into those companies which have not just created and delivered a good ESG strategy, but one which is then disclosure is strong, where the communications are strong, and it needs all those elements. But what we're seeing is an increasingly efficient market in allocating capital to those that are winning or demonstrating intention to travel in the right direction. So I think that's very encouraging on both fronts. One, I think markets are increasingly acting in a logical way and in an efficient way, and that the outcomes can be, if the agendas are good and the campaigns are well directed, I think they can be, in whatever sense that means, for good. Yeah, I think it's an encouraging backdrop.
Thank you, Andrew. Amanda, in this context, with any further thoughts that you have of your own, but particularly, what are the views that you have on the sort of ongoing debate around divesting versus engaging?
Sure, and I think that this is a really difficult debate that continues, because on the one hand you have investors that want to divest, obviously, from fossil fuels and have been divesting. On the other hand, if you divest, you can't be a real driver in that change, because you've now taken your voice within a company's stock or position and put it to the side. So I'm gonna go back to the engine number one Exxon example, just because it is very fresh in my mind, having worked on that campaign this year. But you take the Church of England, for example, which was straight out of the gate, and obviously CalSTRS supporting engine number one, which was this firm that had just launched with the 0.02% stake in Exxon that no one was taking seriously. But those two very established investors obviously lended credibility to their argument. And Church of England had been divesting, and think about what could have happened at the very outset of this campaign had they not been there to support, because they had chosen to divest. Also think about the investors that really showed their support along the way, in terms of New York Common and terms of CalPERS, and really being able to show that as being investors in this position, even though it is a company that might skew in an industry which is not technically ESG friendly, you have to be involved and be engaged in order to help turn the change. So I think that we're seeing a lot more engagement and really thinking about ESG going forward, what it really means. Do you want to divest and not help create that change over time, is something that I think a lot of investors have to be considering right now, and thinking about what it really means to be able to help rather than just push the problem away.
Could I just add to that point as well?
Please, Kevin. Yeah.
I think the other dynamic here, which makes this debate interesting, is just the rise of passive ownership in general. So, if we're looking at a world where kind of the top funds, the top passives, the BlackRocks, the State Streets, the Vanguards and such, control something like 30-40% of U.S. assets. And, a large portion of that, is indexed. You get to a world where the engagement is almost kind of baked in because, they have to hold positions relative to the benchmarks. And so the divestment question, I think, becomes an interesting one. And I agree with Amanda that you're starting to see, and I think this is some of the trends around companies that are having much more of a voice in these issues, because by the nature of their investing strategies, they will follow the benchmark. The other dynamic that we're seeing is one that is coming up more frequently is, particularly for industries that have had more pressure on them. So think the natural resources sector, the industrial sector, the larger carbon emitting sectors as an example. For the last few years, the question was, okay, what are you doing about these assets that maybe are dirtier or have more environmental impact to them? And should you be kind of getting rid of those assets? So not divestment of the company itself, but of an asset divestment strategy. And I think more recently, people are recognizing is that companies may improve their positioning by getting rid of assets, but those assets don't go away for the most part. They either just trade to another entity or they, go into the private market. And there is a big question about, is it a better option for folks to keep assets and manage them in a responsible way that kind of aligns with the overall societal objectives versus, selling them or putting them in the hands of maybe less responsible actors. So I think we're going to see a lot of change in terms of how investors and broader stakeholders think about particular industries that are going through these transitions, because it's a very tricky dynamic in terms of what's the best option, both for a company perspective, but also for the impact more broadly on society. So it'll be very fascinating to watch how this all kind of transpires.
Thanks, Kevin.
Can I say?
Yeah, please, Andrew, go ahead.
Yeah, only because I actually think it's even more than that. I think it's a very dangerous area. We are currently, collectively, we are influencing industrial strategy in a very profound way after quite an accelerated move, as we've said, in terms of the development and the acceptance of ESG. And those strategic decisions are having real consequence, societal impact in terms of how businesses are closed or relocated or spun out and left to operate into their own devices. And I think what's going to happen is there will be a point of where we'll look back and go, the influence that we had, the things we asked companies to do at that time in these years turned out to actually have a negative effect, and there'll be recriminations as a result. And I think that will be, the challenge actually now is to try and look beyond the current urgency of what is needed, and rather than find easy solutions to reduce emissions as reported by an individual company or entity, is to look at what the right solutions are for an industry large. And of course that takes a different kind of perspective, and it takes the influence of governments and other institutions. But it's certainly the investment community has a lot to do on this. It certainly may have a lot to answer for if its engagement creates this kind of change, which, as I say, could be counterproductive, looked at 2 years down, 5 years, 10 years down the line. It makes it very difficult actually to navigate this next path. We're always asking companies to look further, to think strategically, and then to get there straight away. But if we do that too much, I think we end up pushing some of these problems into other territories and regions, and in weaker state than they are currently. So it's definitely something that needs to be analysed more carefully, perhaps, than it has been over the last couple of years.
Thanks, Andrew. And by the way, guys, we've got quite a few questions coming, which is fantastic. I will see if I can get to all of those, certainly as many as possible, over the course of the discussion. There's one which sort of came in during the course of our discussion on this. And Kevin, I think you touched, and Andrew, you highlighted the complexity, I think, which Kevin was hinting at there. I'll ask the question that came in from the audience member, which is, what are the implications for stranded assets that can occur through divestment, which I think is central to the question that we really just asked you. If anyone wants to address that more directly than what they hinted at in the answer already, thoughts welcome.
Okay, shall I take that to start, and then we can just because it kind of because I was just talking, and I mean in the sense of the stranded assets that we're talking about here are exactly that example. So it's about saying you may have a coal asset, it may be in a different outside of core territory, but within a business which is large enough to manage that asset over time to reduce either emissions or operate it more efficiently. It may end up closing over a time period that's defined and can be financed because of that that other entity. And if the alternative that it is rapidly spun out, as the questioner says, is then stranded, it's stranded in every sense. So, but particularly in terms of capital, it can't afford to run it necessarily as well as we would like. It can't afford to close it early if that's what's necessary, or to apply technology, to a greater degree. And the consequence is very negative, but not just in terms of emissions, but that immediate society that exists around it will be really compromised. That's the consequence of stranded assets, and so that's why it's a challenge, and not the only and obvious answer, even though it might seem easy.
Amanda, Kevin, any other thoughts on that one?
No, I agree with Andrew's points on that. I think there's a real world risk in terms of certain assets getting in that position. And when you think about stranded assets, it's all those things that Andrew had mentioned. It's the economic aspect of it. It's policy risk. It's operating efficiencies and so forth. And so, there's a real world risk here that some of these assets fall into those types of situations, or even become not stranded per se, but maybe strangled in a way, even within a company, because all those factors are still pushing on them.
There is, it is part of the complexity of figuring out exactly what the right thing is here, and I've often kind of referred to the danger of sanctimoniousness within the ESG, if you like, and that's something that, of course, there is now stronger awareness of and stronger sophistication around, I think, from the investment community about wanting to manage that, sort of more deliberately. Let's go back to the audience for a second. My glamorous assistant, Sam, will help us with a few more questions that we're going to ask to the audience, just to make sure that you're paying attention and listening. Can we bring up the first of those questions, please? So what proportion of companies currently set targets for emissions? You've got 4 options. Is it more than 70% set targets for emissions, between 50 and 70%, or between 40 and 50%, I think we've got 55% here, but between 40 and 50%, or less than 40. I'll give you 10 seconds or so to offer a response on that. All right, let's make the assumption that anyone's got an opinion about it has managed to click on one of the buttons. So let's have a look at what you said. All right, so interestingly, quite a pessimistic view on a proportion of companies which set targets. Almost no one said more than 70%. Second, 50 to 70%. Quite a number, 33, a third of people thought it was between 40 and 50, and less than 40% was voted for by nearly half our viewers. I can give you the actual answer. The answer is 42%. So it is right on the cusp of that. It's between 40 and 50, but right on the cusp of being in that sort of bottom section. So audience has just about got it right there. Well done. All right, on to the next question. What proportion of companies provide data on how they are meeting their own policy targets? 25%, 35%, 50%, or 60%? The proportion of companies providing data on how they're meeting their own policy targets. I'll give you a few more seconds. All right, let's see what we've got. So again, there is low expectation of the number of companies, proportion of companies that are providing data on how they meet their own policy targets, with 25% and 35% being equal, just over a third of the audience on each of those, and then a relatively small proportion on 50 or 60%. The answer is 25%. So the pessimism is well founded so far. There is still a lot of maturity to go, I think is probably the way that I'd describe it. And then the final question, which we'll ask you, which we'll ask the audience, how many investors exclude companies? I think this goes right back to our question that we just asked the panel here, but how many investors exclude companies that violate international human rights? So more than 70%, between 50 and 70%, between 30 to 50%, or less than 30. I'll give you 10 seconds or so to click one of those buttons. All right, let's have a look at the answers. Okay, so 10% said more than 70. Optimistic, I like that. Not true, unfortunately, but optimistic. Just over 20% said between 50 and 70. Nearly 30% said between 30 to 50. And 40% of you thought it was less than 30%. Unfortunately, the 40% of you are correct. It is less than 30% of investors exclude companies that violate international human rights. Interesting enough, I think it's worth pointing out these. If you'd have asked this question, just 2 or 3 years ago, the answer would have been much, much more obvious. The fact that there's a question to be asked now based on the engagement of the investment community, particularly the institutional investment community, makes for some interesting trends. And I think we all hope and expect that will improve over the course of the coming couple of years. But it still goes to show exactly where we are in terms of state of play today. All right. Let's come back to questions for the panel. Kevin, one of the proposals in the report is that communications and disclosure is actually one of the major improvements that companies can and should make around ESG, as opposed to actually the sort of changes that the company needs to make themselves. It's rather just about their clarity of reporting and their transparency around disclosure. How true do you feel that is?
So look, I think communications and disclosures are important part of the overall framework for how you think about performance of companies, but it's just one element. And in some ways, look, disclosures are good because they provide transparency. They allow stakeholders to have views as to how companies are performing against their strategy, but they tend to, by nature, they are backward looking as opposed to forward looking. Disclosures also, where they're not consistent or standardized, can become confusing to the market in some cases. So you have less comparability across companies and so forth. And so when I think about almost the hierarchy of how we advise clients in terms of setting their sustainability strategy, it's really understanding the issues that are relevant for your company or your sector, both risk and opportunity. It's getting a sense of where your position is, so a peer benchmarking, if you will, looking at other companies, even outside your industry, and what they're doing from a performance perspective. That helps inform and set your own strategy, right? That strategy, as we mentioned before, should be intertwined with your business strategy, so you get the financial and economic thesis tied in there. And that can be everything from target setting, goal setting, capital allocation decisions, and so on and so forth. Then you communicate that strategy to the market and provide disclosure against it. And that element, I think, then, to my point earlier, creates awareness in the marketplace of where the company is going, what is it looking to address from a risk perspective, how it's looking to seek opportunity from an opportunity perspective, and then people will measure them against that disclosure, and that's where you see progress reports and so on and so forth. So I think communications and disclosure tends to probably garner more attention in the community because, to be honest, there are a number of rating firms out there and others that are looking at largely disclosures and things like that feed into scoring and so forth. But really the crux of it is understanding the company's strategy, how it ties to the financial and economic thesis of the company and the business drivers there, and then measuring their performance over time in the journey of going towards the targets and goals that they've set. To me, that's the most important thing as you think about communications in the context of a broader strategic package for a company.
Thanks, Kevin. Andrew, we've talked about different sectors a little bit already, but any further thoughts, including what the research showed up to you in the report that you did around the particular bias or nuances between sectors and industries when it comes to ESG activism?
Yeah, sure. Actually, if it's all right, I just want to add something Kevin just said, because
Please do.
that is just because it's a huge topic, and in terms of disclosure and resource in that, and how companies are dealing with it. When we did the report, we found it quite startling how different the importance of this was to companies, but how consistently important it was for investors, and that's played out in a number of ways. And what we found was that there are a number of different kinds of ways that there was a problem in the disclosure, and part of it is just by being new to or early to that challenge. Part of it was for some a bit of indifference, but both of those things are dwindling very rapidly. It's more about the capability to reflect what is often increasingly a good ESG strategy through the disclosure. But it's making sure, I think as Kevin said, it has to have integrity. It has to start with the business, and those that ran beyond their own position in ESG, I think that's running out of road. Whereas the efforts were those where the ESG commitment is strong and the understanding of what it takes is strong, and how that's then disclosed. I think that's bearing fruit very much so. But it is, to join that to your question, it is different across sectors, and there are some which have had to been challenged earlier by nature of what this where much of this part of the campaign or movement has taken it, often from an environmental point of view, around emissions. So those that are emission heavy obviously were in the frame to start with, and they're challenged in order to stay relevant and to have secure and retain investment. They actually worked harder earlier to try and improve the way that they were able to present what they were doing. And obviously I'm talking about oil and gas and coal and utilities, but actually when some of the analysis within that and what's affecting the activism trends is that the efforts have been strong, but there's still significant gaps between that and where they should be. So they're the most immediately vulnerable and obvious case. But I think what we saw also in the work that we did was that there are others that are less obvious, which are getting more attention, and that's because of the way ESG itself is evolving. And I think, as Amanda mentioned at the beginning of this, in what she said about how society is becoming, the societal element of ESG is becoming more important, more sophisticated, better understood, and the problems that are revealed by it, we're seeing those sectors, particularly around the supply chain and the liability that exists there. Those are the areas and the sectors which perhaps, so it speaks to technology, it speaks to retail particularly, and those are the sectors which I think are getting more attention more recently. That's what the work found. I'm interested what the other presenters might have seen.
Yeah, Amanda, any additional thoughts on that?
Yeah, I mean, to Andrew's point, I couldn't agree more. I think we're seeing a large uptick in some of the technology sectors through the supply chain issues. So you're not thinking about, buying toilet paper online, for example, or walking to the store to get it. You're thinking, oh, I'm buying it online, but then you're not thinking about the chain of reaction of how that gets to you and the types of trucks that these companies are using or not using, and various ways that companies can be improving their supply chain. I was actually speaking to someone recently who's also involved in ESG work, and she was saying, why can't we just have like Alexa? You say like, hey, Alexa, order me toilet paper, default to like a toilet paper that is maybe a recycled paper or something that's more environmentally friendly. But right now it doesn't do that. So there are definitely ways that we can improve. But I think that those issues are coming much more to the forefront now, particularly as Andrew said. And I think that we're going to see that increase. And also investors look a little bit deeper into that as well.
Thanks, Amanda. So, panelists, we've got a slew of questions which come from the audience, and I want us to try and work through as many as possible. I have a couple more, but I'm going to put mine to the side because I don't want to shortchange the audience, because I think there's some really good questions in there. So this is kind of open to everyone, so feel free to just sort of jump in and be assertive, panelists. Very pertinent to the current situation, given the higher energy costs we're already seeing. Are customers willing to pay a premium for being green?
Contentious. I'll try and start because it's not clear, right? So it's not clear because of where we are right now in this, in October 2021, because it would have been easier to answer this question 6 months ago. Without question, there would be a tendency, a willingness, and acceptance to pay a premium, as you say, for that. There are two senses of how to pay a premium or accept a cost of a greening strategy, and some might be to accept lower profitability and returns from an investment, and then a consumer being prepared to pay more in terms of energy bills. But they are aligned, right? And there are times when it's easier to say I will because it's a premium at a lower cost, or if it's an investment term, prepared to accept a discount conceptually, but actually believe that there's that good investments that are ESG positive will end up trading at a premium and outperforming. So whether the answer in either of those cases was true to the real thrust of the question, it's very different right now. So in terms of scarcity of supply, it's real, it's tangible, it has a strategic country strategic risk to it. And I think the timing of it ahead of obviously the COP debates that we're going to see unfold over the next month are crucial, and I think it'll face far more challenge than it would have done a year ago, 6 months ago. So I think the answer is that tide may be changing at the moment, which is obviously dangerous, because if that's a reaction to hopefully a short-term issue, then with a different kind of outcome. What you want to see is obviously things normalize, and then you can see what the true premium. In answer to the question that's been posed, the premium is now been fast, increased and overtaken by the scarcity of supply issue, and the risk is that people conflate those two at a time of weighing their own opinion, because certainly the pressure on consumer is very real and going to be very painful. So the answer is going to be more difficult right now.
Thanks, Andrew. I'm going to move us on to the next question, only because there's quite a number. I want to get through as many as possible with some answers. So, Kevin, I think this one's probably best for you, but I'm happy for anyone to chime in. Will Western institutional money need to be forced to allocate enough money to emerging and developing markets to meet climate goals? Because of course those emerging markets are using less ESG metrics.
Yeah, I think
so is that an excuse not to invest there?
Yeah, look, I think there's a role to play in the Western world investing in emerging markets to help with that kind of transition. I'm not sure they will be forced, because that's kind of a hard way of looking at it. But I do think as technologies improve, as opportunities improve, you will start to see people moving into other markets, not just because it's the right thing to do, but because there could be economic opportunity to do so, right? And so you can think about that in the context of a number of different things. Is oftentimes, new technologies enable you to leapfrog over kind of the prior way things were built. So, if you think about that kind of telecom industry and so forth, right? Like creating a wired network in the emerging world probably doesn't make sense in the context of a cellular or 5G world that we'll live in. And so you can see that same analogy playing through for different sustainability and ESG themes. Energy sector is prime for that. I think water is, infrastructure and things like that will be prime for that. So will institutional money flow there? No doubt it will. Are there risks? Of course, there's many other risks when you go kind of into more emerging and frontier markets. I do think the public sector plays a huge role in that, in helping catalyze that investment, both directly and through, the work of the multilateral community, and help maybe reduce some of those risks, because they are real. And, at the end of the day, asset managers have decisions that they have to make, and they're looking at opportunity on across the spectrum and where they put their dollars. In some cases, they're finding more opportunities in developed markets than in emerging today. So I don't think they'll be forced per se to do it, as I mentioned, but I think there'll be opportunities that will present themselves to have more capital flow to, the emerging world than maybe just the developed markets. And also, as money gets more crowded in developed markets, people will be looking for those opportunities.
Do you mind if I just add to this, Leon?
Please do.
This and the other question, because I think you're looking at both the consumer and the investor perspective here, respectively. And I think the one thing we haven't touched on too much is the lack of education, which I think is a huge piece of this from the consumer standpoint and the investor standpoint. I mean, just working with, a number of investment managers, people are just starting at some firms to scratch the surface and putting, ESG frameworks in place, and even thinking about how to incorporate this into their investment, strategy and thesis in response to LP demand for that. So I think that there's a significant, even just taking this webinar, for example, I think we've seen an uptick in those wanting to get educated on this space from a company and investor and advisor perspective. And I think that there's a lot more room for that, and we're going to see that increase, and that will also have an influence on the way consumers think about what they're buying, and investors are thinking about how to put their dollars to work globally.
Thanks, Amanda. Maybe sticking with you, I'm going to smudge two questions together here because I think they're interrelated. How do disclosure frameworks like the TCFD play into the role of identifying the linkage between ESG and the bottom line? And related, to what extent is the lack of a common taxonomy and clear quality of data a reason why policy targets are so few or so little at the moment?
I think this goes back to something that Kevin was saying earlier, and I think it's a bit of a difficult question to ask. Obviously, with frameworks coming together, they're very helpful, but in terms of a standardization, it's going to be very difficult. And as a result of that, I think that different companies are going to find it challenging to understand what they need to reach in order to sort of benchmark success, and also what investors are going to deem successful. So I'm not sure that there's a clear-cut answer here. I think that we're trying to move towards standardization. Obviously, I think that across the pond, you guys are doing a better job than we are over here, but it's sort of a wait and see right now.
Shall I add to that, Leon?
Go for it.
Yeah, so I think that's absolutely right, and definitely the regional difference is a challenge. The multiple standards are a challenge, and frameworks and regulation is progressing. Specifically, TCFD, of course, it will be great. It'll take time. It's a huge weight of on companies, and the requirement of disclosure by 2025 is going to be a considerable task. But it'll definitely make things more efficient, more clear cut between. Whether it helps show the benefits to the bottom line, I think is what you say. It's like it will certainly show the differences between companies more starkly, and it will accelerate the way that there's a more unified approach. When we talk about the regional differences, which is a real, on the one hand, a frustration, but I think this point about saying, say, Europe and then UK and then the US and Asia, where are they in this trend of regulation or standards? It's the good element, or the reality is that capital markets are global, and there will be a trend towards accessing that capital by meeting the higher standards that are around, and I think multinationals, but also domestic companies, are very aware of that, or at least we try to help them understand that, so that it's not about looking to your own market for where regulation sits currently. It's looking to where you can compete for that capital by aspiring to meet those higher standards. And so it doesn't. What you don't want is a constantly cranking up of higher standards, and that people have to reassess, the nature of which they are disclosing. And what you do want is to have someone who, are drawing those behaviours under an umbrella of as appropriately sophisticated disclosure, which can be consistently applied, across industry.
Kevin, let me come to you. The future of ESG activism, is it a fad? Is it a niche? I'm not intending that as a hypothetical question, given everything we've discussed over the last 50 minutes, or is it an integral part of all activism going forward?
It's a good question. I think that it becomes more of an integrated approach. So it becomes one of the arrows in the quiver, if you will, from an activist perspective. And it's interrelated. So, looking at the environmental issues or the social issues that a company may face is something that I think smart investors will naturally do. And maybe it's a little more pointed with some more, spotlight on it today. The governance issues have always been there. And I think Amanda said this well earlier. It's kind of table stakes at this point, and looking at how a company kind of has appropriate oversight. And what that oversight looks like is an important wedge also for how activists think about it as well. So when they think about board replenishment, do you have the right people overseeing the company? Is there a diverse set of views and so forth? So will it be called ESG activism or something else? Probably not. I think it becomes more integrated in an approach, and what I mentioned earlier was this fundamentally is about identifying risk, maybe non-traditional, non-financial risk, finding opportunities where there's improvements in efficiency for a business, and identifying areas of potential growth or opportunity. And at the end of the day, that's just good investing. You can call it ESG investing, you can call it what you want, but at the end of the day, that's what I think the broad community will be looking towards, including the activist community, in terms of where they can recognize value and have change. And it will take a different form for everyone. And like I said, my view is it becomes integrated over time, but in the probably near term, maybe garners a little bit more of a direct attention given the spotlight on these issues.
Amanda, any additional thoughts to what Kevin just mentioned?
So I think Kevin really summed it up well with the arrow in the quiver analogy. I think that we're going to see ESG, the acronym, probably fall off over time, and this just be another way that or another arrow that gets integrated into activism. And one of the focuses for investors going forward, just given the amount of opportunity there is, particularly with ESG, to be able to, we know, do better right now. So I think that obviously there are other parts of activism that will continue to be very important, but I think this is going to be integrated going forward, and probably lose the ESG sort of fad acronym and just be part of investing and activism.
I'm going to have one final question from you. There is more Q&A, and we haven't been able to get through everything. Thank you very much for your engagement from the audience, and we'll look to follow up with anyone that we didn't manage to respond to for any of the good questions that we haven't managed to address. But let me do one more from the audience, which is an interesting one, because of course we've seen trends about companies staying private for longer, or more companies going private and less going public. And as we see that trend, how does that relate to activism and regulatory pressure if effectively more companies effectively will avoid that at least that direct activism and regulatory pressure by not being publicly listed. Is that a concern? You see that as a trend, which is going to sort of cause challenges here? Any thoughts on that?
Yes. Shall I say something there?
Yeah, please, Andrew. Yeah.
Cool. So yeah, I mean, it definitely is. So there's, the markets and equity investment, and indeed fixed income investment is one route to secure capital. And if that cost goes too high because of the nature of the business, then of course there will be a consequence on the valuation, and there'll be a tendency to go elsewhere to source that. But that might be, on the one hand, it might be appropriate because then you've had that effect. And so hopefully there'll be change as a result of it, change either in priorities or that capital allocation or strategic direction of those companies. It might be, but it's not all positive if it means that what you arguably want to do is to bring those opportunities into an area where there can be a stewardship and governance which is progressive, and that works within an efficient market with good disclosure. The problem with things staying private for longer is by definition they're less accountable, and so this is a huge subject. We could have spent a whole hour on this on its own, but it's definitely right to understand that there is a consequence to this momentum that we're seeing at the moment, because it will redirect capital and it will change the strategic direction of many parts of industry. That's definitely happening at the moment.
Very good. We've got 2 minutes left, which means there's less than a minute for each of you to provide us with a final quick thought to leave us with. So Kevin, let me start with you.
Sure. So maybe I'll just gear this towards maybe the greater percentage of the audience coming from the corporate space based on the polling earlier. As I mentioned earlier, when we advise clients on how they can perform well from an ESG perspective and, kind of think about their vulnerabilities to activism, to just general stakeholders in practice, it's really about setting a strategic plan for your business, both where you're going, how you identify risk, how you are benchmarked against others, and really also, what is your plan in place should an activist show up or others show up. So I would just leave you is to say this kind of emerging world of ESG investing, and the point we made earlier about it being increasingly integrated into how all investors and how stakeholders view the world, I don't think is going to change. There's going to be more of it in a more integrated fashion. And so the best thing that you can do is to really have kind of a plan in place and set a strategic direction for your business to perform well in that regard. And so, that's something I just maybe leave the audience with as we kind of round out here.
Thanks, Kevin. Amanda, 30 seconds. Anything you want to say quickly?
Sure. So just piggybacking off of what Kevin just said, I think that for companies as well, obviously it's important to listen to your shareholders. Sweeping them under the rug, no matter the size of the stake, no longer works. And to that point, also in terms of being prepared, be transparent. If you're ready to showcase some of your ESG plans to the world, show them. I think that the worst sometimes response to activism is that companies, come out and say, "Oh, we were just about to say this." Be transparent now. Don't sort of sit on your hands and wait.
Thank you, Amanda. Andrew, we've arrived at time, so I'm not sure I can leave you any final thoughts other than to say, read Andrew's paper, Staring Down the Barrel of ESG Activism. I think you'll find it really interesting. It's highly insightful and I think touches on a lot of what we discussed today. Thank you to my illustrious panel. I think that was really interesting. Thank you to the audience for being so engaged. I'm sorry we couldn't quite get to all of your questions. Thank you to Sam, my marketing person who's helped to actually organize this and set this up so that we look reasonably professional here. So thank you to all of you, and we'll follow up with details as to where you can access the recording after this on email. All right, thanks for joining us.
Thank you.
Thank you.